听见资本，本期视频为您带来的是摩根大通在3月21日关于全球商品石油价格的观点。油价为什么总是不温不火？自去年9月以来， Brent 原油价格一直在$70左右晃荡，低于它应有的价值，这让不少人开始关注所谓的石油市场维护者 OPEC 联盟的动向。Natasha 在会议里提到， OPEC 似乎对市场波动没那么紧张，甚至计划从2025年4月起逐步增产，而不是立刻出手稳住价格。新闻里也说，除非供需严重失衡， OPEC 可能不会轻易改变策略。与此同时，美国对伊朗的制裁又加码了，提出了2个月内搞定新核协议的要求。地缘政治局势一下子紧张起来，可油价却没啥大反应，市场淡定得让人意外。全球经济这边也是喜忧参半，美国经济增长有点放缓的苗头，但欧洲和中国表现还不错，算是稳住了石油需求的预期。数据显示，全球石油需求今年增长了160万桶每天，虽然比预期略低，但韧性还是有的。社交媒体上，大家对油价走势看法不一，有人觉得短期内还会徘徊在$70多，有人担心长期会跌得更厉害。美国对伊朗的强硬态度是个大看点，Trump政府一边制裁一边喊话要和平协议，搞得局势扑朔迷离。新闻报道说，如果伊朗石油出口真被大幅削减，油价可能会飙到$90多，但沙特和 OPEC 未必会补上缺口，这跟2018年那会儿可不一样。石油需求方面，美国航空旅行数据有点下滑，但整体需求还算稳。欧洲和中国的表现也帮了忙，这些因素怎么互相拉扯？ OPEC 会不会在关键时候出手？油价又会怎么走？全球石油市场这盘棋值得一看。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello and welcome to another episode of At Any Rate. I'm your host Natasha Kanova and I head JP Morgan Global Commodities Research. Today we would like to discuss the latest news in the oil markets and why the price of oil has been sitting stubbornly below its fair value since last September. We call this phenomena oil vigilantes in action. The term bond vigilantes has long been part of the market vernacular, referring to the concept that if governments of central banks engage in excessive spending or policies that might lead to inflation or unsustainable debt levels, bond investors, through selling bonds, will seek to exert pressure on governments or central banks to adopt policies that they perceive as fiscally responsible, often by raising borrowing costs. Oil vigilantes, on the other hand, is a concept suggesting that when challenges arise and oil prices plummet, the OPEC alliance will intervene to stabilize the market and prop up prices. This perspective was echoed during a Bloomberg panel that we attended at the International Energy event in late February, where almost 20% of respondents identified OPEC's output decision as the most influential factor for the oil market this year, compared, for example, to just 3% who viewed non-OPEC supply growth as the primary driver of price formation. So far, oil vigilantes have been found wanting, as the Trump administration prepares to impose hefty tariffs on a wide range of imports starting on April 2nd, which will affect virtually all countries and increasing the risk of a recession. Oil prices have indeed tumbled, with Brent crude trading just above $70. Aside from a brief dip last September, prices are at their lowest since December 2021. In tandem, Brent and WTI prompt time spreads have also weakened. Yet this hasn't set off any alarms at OPEC. Instead, the alliance has demonstrated greater tolerance to the potential adverse economic fallout from tariffs and has opted to proceed with its plan to gradually increase crude oil output beginning in April 2025. Those who were waiting on a put expecting OPEC to reverse its stance are now facing the possibilities that they may have misread the market. We believe that for the alliance to change its course, significant market imbalances such as a sudden drop in demand or a large increase in supply leading to swelling inventories would likely be needed. So far, none of these conditions have materialized. The downgrades, for example, in the US GDP from our economists have been almost fully offset by upgrades in Europe's and China's growth, keeping our oil demand projections unchanged. On the inventory side, while OECD inventories are 4% above their 2000-2015 levels, they remain 3% below the 5-year averages. This is the metrics that OPEC is closely paying attention to. So the short-term outlook is also unclear. Our fair value model suggests that current Brent prices which are hovering in the low 70s, are about $6 undervalued, but we believe that most of this underperformance is likely due to a large 30% decline in the U.S. trade-weighted dollar since mid-January. Net investor positioning remains short, and from a technical standpoint, Brent prices are attempting to stabilize near their July 2023 channel support level of just about 4 cents below $70. But the lack of pattern-based buy signals and the choppy nature of the recent bounce make it difficult to confidently assert that the rebound over the past week or so marks a sustainable transition to a rally phase. Fundamentally, we still anticipate Brent prices to recover into the mid to high 70s over the next couple of months before dipping below $70 and ending the year in the mid-60s, averaging around $73 this year. Our outlook for 2026 remains decidedly bearish, with substantial surpluses from 2025 carrying into the following year, pulling Brent prices down to the high 50s by the end of 2026. At some point between now and then, we expect the oil vigilantes to emerge. So a couple of news this week. Number one is that the relative calm in the Middle East that has lasted for nearly 2 months ended on Tuesday as Israel launched a series of airstrikes across the Gaza Strip, Lebanon, and Syria, and the U.S. ramped up pressure on Iran with attacks on the Houthis in Yemen. Just hours after the collapse of the ceasefire deal in Gaza, President Trump held a call with President Putin, during which the Russian president rebuffed Trump's push for the full ceasefire that the U.S. had agreed upon with Ukraine last week, consenting only to a limited truce on targeting energy and infrastructure assets. The breakdown of the ceasefire in Gaza and the outcome of the call, this was the second with the Russian president since Trump returned to the office, highlights the challenges of translating Trump's vision of a quick peace in Ukraine and Gaza into a workable agreement acceptable to both sides in this conflict. Amid the prevailing uncertainty, however, the risk of sanctions is once again coming into focus as the Trump administration adopts a tougher stance on Venezuela, Iran, and Russia. In particular, the situation with Iran is quickly coming to a head as President Trump has proposed a new Iranian nuclear deal with a 2-month deadline. So it isn't clear whether the 2 months countdown begins when Trump's letter to Iran's Supreme Leader Khamenei was delivered, or from when negotiations will commence. Assuming Iran agrees to talks immediately, that applies a deadline in late May or June. Trump has expressed multiple times that while he wishes for Iran to prosper, the country cannot possess nuclear weapons, stating that he would rather have a peace deal than the other option, but the other option will solve the problem. And we saw the ratcheting in sanctions announced yesterday. Yet, despite those escalation tensions, Brent implied volatility remains low, and oil prices are trading at a discount to fair value, while, for example, gold has surged to a fresh all-time high. It does appear that every single day there is a new record in the gold prices. So we maintain our view that the Trump administration will likely opt not to enforce sanctions, favoring diplomacy that could culminate in some form of diplomatic agreement. In our opinion, the ultimate constraint on sanctions is the price of oil. For example, we believe that to successfully pressure Iran or Russia into negotiations, sanctions would likely need to cut both countries' oil exports by about 1 million barrels per day each. Under this scenario, we estimate that Brent prices could rise from the current $70 to $94 by the end of this year, assuming a linear price response, which is not the case. Usually, everything that Iran is involved, there is like an exponential response from the price. While Saudi Arabia could potentially expand production, the restored ties between Riyadh and Tehran have reshaped the diplomatic landscape, presenting a new reality that the Trump administration must address. It may be unable to fully recreate its 2018 network of allies to pursue an intensive anti-Iran policy, especially if the policy lacks a clear end goal of reaching a comprehensive deal with Iran. In the context of energy, this could imply that if Trump proceeds with curbing Iran's oil exports, unlike in 2018, OPEC might not compensate for the lost volumes. Instead, it would only gradually increase its oil production by the predetermined 138 KBD starting from April over the next 12 months. A sharply higher oil price would fuel U.S. inflation, conflicting with Trump's pledge to rapidly reduce consumer prices, but also his pledge of substantially lower energy prices. The second news we would like to discuss is the state of the oil demand. So the incoming hard backward-looking data are moderating. That's what is visible in the data, but at the same time, they still demonstrate overall resilience. So, for example, year-to-date, global oil demand has increased by about 1.6 million barrels per day, slightly below our expectations of 1.7 million barrels per day growth due to reported downgrades in demand from Canada, Mexico, and South Korea. The lion's share of demand growth in the first quarter was driven by the increased appetite for heating fuels, very cold winter, about standard and a half deviation below 10-year averages, like very close to 30-year averages. However, the assessment of risk is evolving given the extreme policy uncertainties and broader geopolitical turmoil. In response to those downside risks, our economists have revised the U.S. growth outlook down by about 30 basis points, raising the likelihood of an end to the U.S. exceptionalism. Conversely, they have raised the level of euro area's GDP growth forecast by a full percentage point through the end of next year, even after accounting for larger drag from larger than anticipated U.S. tariff hikes likely coming in April. Additionally, following a notable policy-driven growth recovery in fourth quarter of last year, China's economic activity in January and February came in above expectations, prompting our economists to revise their first quarter growth forecast to 6.6%. That's quarter over quarter, up from the previous estimate of 5.3%, thereby boosting the full year growth forecast to 4.6% from the earlier projection of 4.3%. So on net, these revisions have resulted in only a minor about 10 basis points dent to the global 2025 growth forecast. So these revisions do not directly alter our oil demand forecast. So we have actually kept our demand unchanged. So it's right now the growth is about 1.1 million barrels per day, like even actually 1.16, so slightly higher than that. A couple reasons for that. First, our models are bottoms up regionally. They're done by product and across 8 demand sectors. And so what that means that our oil demand consider factors such as expanding vehicle fleets, trucking, leisure mobility, petrochemical product use, industrial activity, global trade volume growth, among others. So second, while that's mathematically, while the U.S. stands as the largest demand center globally, with beta of oil demand to GDP at 0.32 in a 20 million barrels per day market, it is outweighed by the combined influence of Europe and China. So Europe has a demand beta of about 0.16 in a 14 million barrels per day market, and China has a demand beta of about 0.7 in a 16 million barrels per day market. Another reason is that the only indicator of U.S. oil demand currently signaling concern is the air travel. So the U.S. TSA has reported about half a percentage point year over year dip in passenger volumes in March, following a stagnant February. But if you look closer to the data, what we have discovered is that this dip is actually only during the weekdays, but the weekends actually is still showing a very strong growth in air travel. So what we concluded, it's similarly to what Secretary of Treasury Scott Bessent acknowledged this week, is that most likely this is coming. This is the impact of federal worker layoffs instead of sending a less ominous signal regarding the state of U.S. oil demand. And finally, notably, the growth softness observed in the U.S. so far is not visible in the other markets. Thank you all to listening to the Commodities edition at JP Morgan's At Any Rate podcast. We look forward to continue the conversation next week. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025, JP Morgan Chase & Company, all rights reserved. This episode was recorded on March 21st, 2025.